Joe, it was absolutely an excellent quarter. That's a 24% increase in earnings per share. And, of course, I have to say the administration's tax reform, without that, this number would not have been possible. And as a U.S.-based company, a retail-based company without all the multinational tax shelters that were available to other entities, we were certainly in a penalty boxes unfairly on tax. And so tax reform was a big part of this, and I should call that every quarter our associates are grateful for that. As far as the core business, brand extension was excellent throughout the quarter. Our strategy there, our pre-owned business was up significantly on a same-store basis with gross profit up 6%, and in our customer care business across the board from precision parts to collision parts, accessories, that business was up 7%. Difficulties in the quarter were certainly the new vehicle business. Now we had some difficult comparisons with the snapback from the hurricanes last year, but still there's headwinds in the new vehicle business that we had to contend with. And SG&A is elevated due to the brand extension, but it's been a very worthwhile investment, and our peak investment period is almost over, and going into next year we'll see a normalization of SG&A, but we'll have the benefit of the brand extension.
That's something we've talked about a lot. It was mostly about recurring revenues, wasn't it, Mike? Services and
yeah.
Tell us about that.
It's a high margin recurring business that we uniquely have the capability to go into because of our scale and our brand. We've seen that our customers trust our brand. It stands for value, great service, and they're willing to buy products that have the AutoNation brand. And we have the scale to be able to.
How many quarters, Mike? Because we've been talking about it for a while. When you initiated, how much? And it did cost money to build that out. And now you say it's going to be. It's not going to be recurring from here on out, right? It's over? You've passed the point of all these investments at this point?
The brand launch was back in late 2014. We had elevated spending in marketing communications to build the brand, and the brand is in a very good place, so we will be able to maintain the brand without the same level of investment that we've had in past. And we had on other capabilities, we had to retrain our workforce across the country to go to one price on all pre-owned, which again customers have embraced and they very much enjoy. And on the parts business, we had to build a logistical supply chain from around the world, bringing parts into the United States from the best suppliers and vendors. And so all that infrastructure is almost built out. We still have some to go in the fourth quarter, but our SG&A will normalize in 2019.